You're watching Economics Amplified, the latest thinking on the biggest issues from UChicago's Becker Friedman Institute.
Professor Mahoney comes to us from a postdoctoral at Harvard studying health research economics. While he was doing his doctoral studies at Stanford, he spent a year in DC working on the healthcare reform. And currently, his research interests are in public finance, industrial organization, and health economics. Today, he's going to speak to us about regulating consumer financial products with evidence from credit cards. So, thank you.
Thank you for the kind introduction. So I'm Neale Mahoney. This is my second year at Booth. I have done a lot of research on health insurance markets. We'll be talking about some new research branching out to study other consumer financial products, studying credit cards. This is the first of what I hope is a number of papers. It's co-authored with Sumit Agrawal, Sufala Chomisimfat, and Johannes Strobel, who was here at Booth last year and who unfortunately left to go to NYU, where I guess his significant other is also an assistant professor. All right. So I think the motivation, actually, let me ask the question. How many people here have taken competitive strategy or are taking competitive strategy? It's the vast majority. So I'm going to talk about this research and try and link it to things that are sort of core to competitive strategy classes that are taught at Booth. I'll also be linking it to concepts that many of you will be familiar with from microeconomics. Hopefully this will supplement the things you think about in class. So the motivation for this paper, there's been in the wake of the financial crisis, there's been a surge of interest in regulating consumer financial products. So perhaps the best example is the creation of the Consumer Financial Protection Board, which was part of the Dodd-Frank Act. So this movement, in some sense, has been spearheaded by people like Elizabeth Warren. So the argument that's been made by proponents of increased regulation is that firms, particularly banks, exploit various biases that sort of regular consumers have when they interact with consumer financial products. So when you think about credit cards, which I'll be talking about, people may just not pay attention to the fine print. They may not notice the size of the late fees. They may be over-optimistic in their ability to pay credit cards on time. They, when making the minimum payments, may not fully understand the increase in interest charges that could result from rolling over a large amount of debt for many years on end. So these proponents of increased regulation, they argue that regulation can, to some extent, solve this problem. They can protect, particularly protect sort of the poor and the most vulnerable consumers from exploitation. There's good reason to be skeptical of the power of regulation to protect consumers. So a standard rebuttal to this sort of argument is that regulations that attempt to transfer surplus, that attempt to create better value for consumers, run into this basically whack-a-mole problem. Regulators reduce certain fees, then banks or issuers of credit cards may just increase interest charges, other fees they have at disposal to negate or to offset that effect of the fee reduction. Right? The impact of other types of regulation, like information disclosures, I think there's equal uncertainty about the effectiveness of those things. It's unclear in a non-experimental setting how often people closely read through their credit card statements and whether those type of information disclosures would actually be powerful. So we're going to study the credit card market. Credit card market is important, approximately just under $700 billion in revolving debt in the United States, seen by basically proponents of regulation as particularly exploitive. So there's a quote from Senator Dodd talking about tripwire pricing. I think this is the one on. tripwire pricing in the credit card industry. It's a place where we've seen, I think, meaningful regulations of the Credit Card Act, which was implemented first in February 2010, passed in 2009, is going to drastically reduce fees and also have an information disclosure designed to teach consumers about the costs of only making the minimum payments. Credit Card Act faced sort of the usual criticism or pushback. The American Bankers Association, many other organizations have argued that there's significant trade-offs, that sort of this whack-a-mole effect is likely to happen. If you reduce fees, then banks have no choice but to increase interest charges. In fact, that was my view going into this project. So Johannes and I had to write a proposal to our co-authors who are at the Office of the Comptroller of the Currency, one of the bank regulators in the United States, about what research we wanted to do. Our title for our proposal was sort of whack-a-mole, the unintended consequences of fee regulation in the credit card industry. So the data shifted our view of the benefits of regulation, shifted our view of what's going on in this industry. So that's why I think this is sort of an interesting piece of research for me, changed how I thought about the world, may also shift your view about the world a little bit. So what did the Credit Card Act do? Well, it reduced fees by approximately 3% of borrowing volume, so a large reduction, well, I guess a modest reduction in fees. There was a particularly large drop, so a really large drop for consumers with the lowest FeeCo scores. I assume everybody knows what a FeeCo score is. A FeeCo score of 620, that's what's the standard threshold for subprime, would put you in the bottom 25% of the distribution. We calculate this reduced annual borrowing costs by $20 billion for US consumers per year. So a sizable chunk of money. Surprisingly, we find basically zero evidence of an offsetting increase in interest charges, a very small offsetting increase in annual fees for credit cards. A lot of the paper, basically we just systematically go through lots of pieces of evidence to try and see whether there's an offsetting increase in fees. We really thought there was going to be one. We can't find any evidence. We also find no evidence of a decline in access to credit, no decline in the number of new accounts and the credit limits of new accounts. Something I'll do in the course of this talk is explain how I think these facts actually fit together based upon sort of our understanding of the market. So I'll present a theory which I think can rationalize these facts, even though they might be slightly counterintuitive. We'll also examine the effect of the payment nudge. I'll describe it in more detail in about 5 minutes. We see a precise but very small shift in consumer behavior. We find that it reduced annual interest charges by, I think, an upper bound of $70 million. So real money if this nudge was costless to do, but perhaps pales in comparison to the impact of the fee regulation. All right, so I'm going to skip the related literature, except to say that Dick Thaler, who I'm sure many of you either know or know of, has been an incredibly influential proponent of nudges, has done some really wonderful work in this area. So our work is building off sort of a lot of what he's done in creating a policy push for these type of things. So here's the outline. I'll spend 2 minutes talking about data. I'm going to provide sort of an overview, a landscape of the credit card industry prior to the Card Act. I think this is just intrinsically interesting. It also sets the baseline for what the Card Act did. I think there's a lot of sort of competitive strategy going on in figuring out why profits were so high before the passage of this law. I'll describe the Card Act, and then I'll walk through the effects of both the fee restrictions and the nudge. Let me say also, I know you're eating, you probably have food in your mouth, but if you have questions at any point, just raise your hand. There's a lot for me to learn about this industry. I'm sure some of you have particular experience in the industry. I'm sure all of you use a credit card, so you probably know quite a bit just from being credit card consumers. So So the data, we're working with data collected by the Office of the Comptroller of the Currency. It's one of the bank regulators in the US. We have pretty amazing data. So basically the universe of credit card accounts issued by the eight of the 10 largest banks in the US. So our data needs to be housed on a server. It's a 20 terabyte server. We're using about half of that. We're using about 10 terabytes of storage to store this data. So a terabyte is 1,000 gigabytes. It's a tremendous amount of account level data. We have data from, basically one of the worst periods in the history of the banking industry. So April 2008 to December 2012. So when you look at the profit numbers, right, something to keep in mind is this is from a period in time when banks were doing particularly poorly. And we have account level information, everything you would see on the first page of a credit card statement. We don't see transactions, but we see everything else, what you pay in interest charges, what you pay in fees, what your interest rate is, how much of your balance you pay off, and so on and so forth. So I'm going to skip the information on the data and move directly to sort of setting the baseline. So talking about profitability, revenue, and costs in the pre-Card Act period. So the way we break things down, we think of credit card issuers' revenue as accruing from sort of three main buckets. So interest charges, this is just what people pay based on their interest rate. Fee revenue, so late fees, over limit fees, a bunch of other types of fees, annual fees that you may be familiar with. And interchange income. So interchange income is what retail stores, for example, pay credit card issuers every time they swipe your credit card. These things range from 0.5% to 4% depending upon the type of retail location. So what are costs for credit card issuers? Well, they're charge-offs. It's default. That's money that people don't pay back. It's the cost of funds. So credit card issuers have to borrow to finance your borrowing. That has a cost based upon the bank's cost of raising funds in the market. There's rewards. So if you're part of a mileage program where you get cash back, that's a cost. Fraud expenses and some operational expenses. Most of the numbers I'm going to talk about will be presented as an annualized percent of ADB. And so what we're trying to do is basically to present every number in an interest rate equivalent. So if I say total fees as an annualized percent of ADB are 10%, you would pay the same amount over a year as if you had an interest rate of 10%. The concept makes sense, just sort of going to be normalizing everything as an interest rate equivalent. All right, so let me skip the numbers and just show you some baseline facts in figures. So the first thing I want you to look at, this figure in the top left, that's finance charges or interest charges as a percent of ADB. About 25% of the distribution has finance charges, or sorry, has a FeeCo score below 620. About 20% of the distribution has a FeeCo score above, I guess 25% has a FeeCo score above 760. So that's sort of the distribution of FeeCo scores. Well, you can see finance charges are, a little bit above 20% for people with low FeeCo scores, and they drop off to 5 or 10% for people with the highest FeeCo scores. So what was really interesting to me, what shifted my view of the industry was when I constructed this graph for the first time. So individuals or consumers with FeeCo scores below, let's say, 620, a lot of them are paying 20, even 30% of ADB per year in fees. So if you're an average consumer with a FeeCo score, let's say, just around 600, you're borrowing $1,000 a year, you're paying $200 in fees. Right? That struck me. I was very surprised by that fact. I guess just based on my own credit card usage, I didn't realize you could rack up fees that high. But these are the 10 largest banks. This is 40% of all accounts in the US. This is what seems to be happening. Net charge-offs during our period, they were really high. So especially for the low FeeCo score accounts, right, they're upwards of 30, 40%, and tail off pretty smoothly as you get to the better credit risks. Finally, another important source of revenue for high FeeCo score borrowers, so probably people like you and me, is interchange fees minus rewards. So for people basically in the top 25% of the distribution, transactors, interchange income is a big driver of profits. And so if you put all these pieces together, some pieces I didn't show you, what you get is a basically U-shaped distribution of realized profits. So the difference between revenues and costs by FeeCo score. So the really profitable people are the low FeeCo score types. People with FeeCo scores below 620 seem to be bringing in about 8% of ADB per year. Other people who generate profits are people like you and me who transact a lot on our credit cards, earn banks a lot of interchange income, and a lot of us probably don't use our airline miles as effectively as we could. So it doesn't cost them so much in rewards. So what does this mean in terms of numbers or sort of concepts you're familiar with? So the average during this period, it's about a 1.6% earnings as a share of ADB. If you adjust for taxes and you scale by typical leverage ratios, you get really high return on equity. So in excess of 50% on average, right? Well in excess of 50% for the low FeeCo score types, well in excess probably for people at the top of the distribution and transactors. And this, right, just to put this in context, our data, so this is charge-offs over, I guess, a 20-year horizon. Our data is basically from this period, right? This is by far the worst period for credit card charge-offs in recent history. I guess probably in the history of the credit card industry. So things were pretty damn good even during a bad period. So the takeaway is, yeah, credit card lending, highly profitable, even in the middle of the financial crisis, low FeeCo score segment. So this view held by proponents of regulation that banks are really earning large amounts off the lowest income borrowers seems to be supported by this data. I think this data is pretty consistent with that view. Doesn't imply that anything can be done about it or that anything should be done about it, but that's the baseline scenario. So any questions, thoughts? Why do we think the low end of the market is so profitable for credit card issuers? I guess many of you are familiar with 5 forces. What are the forces that allow credit card issuers to earn so much in this part of the market? Sorry? They're revolving, so people are borrowing a lot. Why don't the typical forces of competition? Sorry?
Bargaining power of buyers. Bargaining power of customers.
Bargaining, so customers don't have a lot of bargaining power? Right. So I think my view, and it's still evolving, is that customers are they either have really high costs to search, so they're not searching across credit cards, or they have really high switching costs. If you have recurring payments on your credit cards for many things in your life, the cost of switching to a cheaper credit card may be high. I think a number of customers probably don't realize how much they're paying, and so if you don't realize you're paying a large amount, you may be also less likely to search. I think there's a number of sort of standard factors that we talk about in competitive strategy which may be leading to this. I don't know the answers, but it's something. Sorry, some other thoughts.
Do you see anything, the people that are getting charged the highest fees, are they moving towards banks that aren't charging as high fees? Like they're being smart consumers?
So that's an excellent question. So the piece of research we're working on right now is to basically estimate price elasticities. How price sensitive are people at different points in the FeeCo score distribution? We really want to know, is this being driven by lack of search, a lack of responsiveness to price. Yeah.
In particular, the amount that you search affects your ability to actually switch. So
right.
People with certain number, like 3 searches is a pretty common cutoff over the last 90 days. If you search too much for another card, then you won't be able to get another card. And there's also less appetite for a bank to take somebody that's, say, 80% utilized in a $1,000 line at 25% and give them a 22% offer, because the likelihood of them defaulting, given that they're seeking out more credit,
right.
is substantially higher.
So 2 great points. One is, I actually don't know how the FeeCo scores sort of account for, let's say, multiple searches on the same day or within a short amount of time. I've heard conflicting things. One thing I'm pretty sure about is consumers think if they search too much, that will be a red flag on their credit report, and so they'll get higher interest rates. So that's a barrier to search. The other point is, this is sort of an adverse selection point. I don't know how many of you are familiar with the concept of adverse selection, but this would be a story where if a bank wouldn't want to offer a slightly lower interest rate than a competitor, because if they did, the type of person who would switch, the type of person who really cares about reducing their interest rate from 24 to 22% is the type of person who's planning to revolve debt for a long amount of time. Right? It's the person who's in a tough life circumstance who may be more likely to default. So if you lower your price, maybe you attract the bad types. You don't want to attract the bad types, so that prevents you from lowering the prices. That sort of inhibits standard forces of market competition. So this is talking about sort of the interaction between adverse selection and market competition. Something else we're actually looking at in the second paper. Do banks that have lower interest rates, are they attracting people? What's the price elasticity? 2, what type of people are they attracting? Are they differentially attracting worse types? All right, so let me move on to the CARD Act. So the CARD Act, signed by Obama in May 2009, 2 key implementation phases. One is February 2010. So 2 things happen here, or I guess 3 things happen here. A restriction on over-limit fees. So before, typically you had to opt out of an over-limit fee. So the default would be that a bank will process a transaction that puts you over the limit, charge you 20, 30 bucks for that privilege. Now, if you don't check a box, banks may not process your transaction, but you don't get hit with the over-limit fee. The other thing is there's some restrictions on late fees. Basically, there's a whole bunch of regulations around late fees. Banks used to have some late fees that or some, I guess, due dates which were at 9 a.m. or 12 p.m. in a day that would trip people up who would make a payment at 5 p.m. on that day. Those were eliminated. Banks used to have due dates on weekends that would trip people up whose mail wasn't delivered that weekend, wasn't delivered till Monday. Those were eliminated. There's also restrictions on the size of late fees. So the other thing that happens here is this payoff nudge. So how many people have seen something like this on a credit card statement? All right, so a share of you. This might explain why it only has a modest effect. So what this tells you is if you only make the minimum payment, right, for this individual, you'll pay off your balance within 10 years, and you'll pay $3,200 in interest charges. These nudges also provide the payment amount which would pay off your balance within 36 months. So they say if you make payments for this individual of 62 bucks per month and you don't spend anything else on your credit card, probably unlikely, you'll pay off your balance within 3 years. You'll only pay $2,200 in interest charges, and you'll save $1,000. That's the nudge. We can look at whether people are shifting away from minimum payments, whether they're shifting towards this amount. Something we can easily look at in the data. There's a second phase of the CARD Act. This is 6 months after the first phase. More restrictions on late fees. A bunch of other changes that we haven't gotten around to looking at yet. In particular, something that's quite interesting is limitations on the ability of credit card issuers to I guess, to advertise and market credit cards at college campuses. It'll be interesting to see what sort of effects that has. All right. So I have half an hour. Perfect. So now I'm going to walk through the effects of the regulations on fees. And to get us started, I want to at least sort of talk through at a conceptual level the theory we have in mind, because I think what we find in the data is somewhat unintuitive, but can be explained, I think, by a very, very simple alternative theory. It's worth at least talking through. I won't go through the math. So I think here's a very stylized way to think about the market for credit card debt. So typically we think about demand, the quantity that would buy a product, as a function of just a regular price, price one. But here I want to allow for two prices, a price that consumers fully understand, price one, and a price two that may be somewhat less salient to the consumer. So I'm going to allow this parameter here to modulate the degree of salience. And so, for example, if this parameter was 0.5, then a consumer would pay half as much weight on this second price, might be fees, as they pay on interest charges. Just going to allow for consumers to underestimate the impact of a secondary price model. Very simple way. All right. So if you write down demand in that way, and you do the standard thing from micro, you solve for the firm's pricing problems, you get something which looks like a Lerner Index. How many people have heard of a Lerner Index? A few of you. You get a formula for sort of the optimal markup of price over cost for the firm. And then you can ask the following question. You can ask, if a regulation comes around and forces banks to reduce price 2, the potentially non-salient price, how much will they increase price 1, the salient price, to offset that decrease? And how much will that offsetting effect, whack-a-mole effect, change if you allow for different salience or different degree of competition in the market? All right. So I think it's easiest basically just to talk through the intuition of the results with two extreme examples. So suppose the market is perfectly competitive. So it's Bertrand-like competition. It's, I think, the stylized example that I give that probably many competitive strategy professors give. It's two gas stations on a country road. If the market is perfectly competitive, then any decrease in revenue from a regulation which decreases price 2 has to be offset by an increase in price 1. Why? Well, in perfect competition, price equals marginal cost. So if you're getting less money from one type of fee, you have to increase the price for the other type of fee. Otherwise, you'll lose money and you'll exit the industry. Has to be one-for-one offset. Similarly, you can easily show if the second price is perfectly salient, people understand it just as well as price 1, any regulated decrease in the second price will be fully offset by an increase in the first price. The logic here, I think, again, is straightforward. If consumers understand both these prices perfectly, then they understand that if you decrease one price by $1 and increase the other price by $1, that they're paying the same amount for the product. So credit card issuers could just reduce one price, increase another, demand would stay the same. So again, this regulation will be completely offset. The twist is, of course, if there is imperfect competition, right? For reasons we talked about. If there are reasons why consumers aren't perfectly price sensitive in choosing across cards, and if fees are not perfectly salient, then, and there's a bunch of theory in the paper, then you can easily show there'll be many instances when banks will less than fully offset the decrease in fee revenue by increasing interest charges or some other price element. Right. So that's the logic. Any questions about that logic? Sort of stepping aside from the math. All right. So what happened? So I'm going to show you a bunch of graphs where I'm going to show you sort of annualized fees or interest charges on the vertical axis. They're going to be as a percent of ADB, so this is an interest rate equivalent. On the horizontal axis, I'm going to show you time. The two horizontal bars in hopefully all the graphs I show will be the two implementation dates in the Card Act. And so this graph just shows the average amount paid in different fee categories for all consumers. So this is actually a different piece of regulation that we're not focusing on in the paper. I want you to notice two main things. One is, so this is over limit fees. They're bouncing around at about 1% of borrowed amount, and they drop off a table. They're 0 after the first implementation phase of the CAR Act, when these went from opt-out to opt-in. The second thing I want you to know, these are late fees. They drop by about just under a percentage point in the first implementation phase. There's some additional restrictions on late fees in the second implementation phase. They drop by, again, maybe half a percentage point, a little bit more. All right, so here's the story for different FeeCo groups. So this group at the top, these are people with a FeeCo score below 620, sort of conventionally called subprime borrowers. They're bouncing along paying fees between 15 and 20% of borrowed amount. Right? Their fees drop substantially, right? This is like a 10% decrease in their interest rates because of the Card Act at this date, maybe another small decrease afterwards. This group, this is FeeCo scores between 620 and 660. They drop by maybe, I think, remember the exact number, I think it's 3 percentage points here and another percentage point here. People with higher FeeCo scores, they weren't really paying much in fees before the Card Act, so they don't see much of a decline. Right? But these low FeeCo score groups, right, they see what is equivalent to a 10% drop, larger than a 10% drop in interest payments. All right, so the takeaways, late fees over limit fees drop significantly. Total decline, we calculate 2.8% of ADB. We do a lot of more sophisticated analysis to examine the robustness of this, to control for various time trends, control for bank fixed effects, et cetera. What you see in the figure is what's there in the data, no matter how you slice it or dice it. Biggest decline for low FeeCo score customers, we estimate that effect at pretty much at 14%. The only type of fee where you see a slight uptick, this is some noise in the data, you may see a slight increase in annual fees. We estimate that increase is at most probably 0.3%, might offset 10% of the fee decline in over limit and late fees. Yes?
Maybe the reduction in the fees is not being transferred to other fees, but to other
This is a perfect segue. So the next thing we look at is no noticeable uptick in other fees, maybe offsetting costs in other areas. All right, so the next thing we look at is interest charges. So this group at the top, these are the people with a FeeCo score of 620. Remember, fee revenue dropped basically by 10 percentage points for these individuals. It's pretty hard to see any increase in interest charges for this group. Pretty much for every group, right? Interest charges are trending completely flat over this period. You know, you might think that maybe they would have increased fees or interest charges in anticipation of the bill, and the bill was passed in February 2009. Very little evidence of an anticipatory increase, no evidence of an uptick at either of the implementation dates. So that's the first thing we look at. Doesn't seem to be an offsetting response. We went into this project thinking that there would be an offsetting response, so we spend a lot of energy trying to find it. So one reason why you might not see an offsetting response is that the Credit Card Act limited the ability of card issuers to adjust interest rates for existing accounts. So let's look at new accounts. The data is noisy, but there's no evidence of anything close to a 10% increase in charges for this subset of new accounts. Now, another thing we can look at, so the American Banker Association, their argument is that, well, yes, you know, we acknowledge the fact that interest charges are flat, But our argument is they would have counterfactually declined if the Card Act hadn't passed. And so compared to that counterfactual decline, we hypothesize that the flat line you see is actually evidence of an increase. All right, let's investigate that hypothesis. So first piece of evidence against that hypothesis, the low FeeCo score groups, or sorry, the high FeeCo score groups, so people like you and me, we didn't see a decline in fees. So if that hypothesis is right, our interest charges should have gone down. Right? Our interest charges didn't go down. So that's not consistent with that view. Second thing you can look at, some banks were especially reliant. So we don't know the identity of the banks in this data, but some banks were especially reliant on fee revenue. Some banks weren't. You would expect that for banks who are especially reliant on fee revenue, at least their fees would, or their interest charges would increase relative to banks which weren't reliant on fee revenue, right? The banks that weren't reliant on fee revenue, they didn't feel much of an impact of this regulation, so they can be a control group that can tell us about the counterfactual decrease in interest charges. So if that sort of effect is going on, well, this is sort of bank level declines in fees against bank level increases in interest charges. You'd expect these points to line up on the 45-degree line. I think they don't. Here's the same effect around the August 2010 implementation date. So you put this evidence together, other drivers of revenue, interchange income that we've talked about. This is the picture you get. There seems to be evidence of a sharp decline in revenue brought about by the Card Act, particularly for the lowest FeeCo score groups. So what about costs? Maybe the reason why they're not offsetting these increases is because their costs are declining. So here's costs over the period. Costs are basically tracing out the effect of the recession. Doesn't seem to be anything particularly interesting going on at the Card Act implementation dates. Here's other costs. Again, nothing seems to be moving in a suspicious way. So this is our conclusion based upon analyzing that bank data, that overall profitability of lending declined, I think, quite sharply as a result of the Card Act. Fees declined by about 3 percentage points of ADB. The average savings to consumers, 3% of ADB, times there was $744 billion in lending at the first implementation date. This is, I guess, February 2010. Gives you savings of almost $21 billion. Seems to have allocated surplus from banks to consumers. And it's consistent with a model with low competition and low salience, right? If the world was competitive, we'd expect banks to offset this fee decline with higher interest charges. If fees were perfectly salient, we'd expect that consumers would understand that if interest charges increased, that they were still getting the same deal. It's consistent with these fees being non-salient, which I think is probably a pretty reasonable view of the world. So what happened to access to credit? So I guess the first point before showing you the data is that banks were earning a tremendously large amount off the low FeeCo score borrowers. So they have a lot of margin, even if their return on equity drops. Since they were at sort of a 50% ROE before, they could deal with a lower return on equity and would still want to issue credit. Right? The decrease in revenue doesn't necessarily mean that there'll be a decrease in access to credit if profits are sufficiently large prior to the Card Act. And so this is what we see. This is the number of new accounts originated, and they're increasing, coming through the Card Act implementation dates, increasing even faster for low FeeCo score groups, so the groups where they lost the most revenue. Here's credit limits on new accounts. So again, seems to be relatively flat for all these different FeeCo score groups. Here's credit limits for all accounts. Again, seem to be pretty flat for all these groups. So the conclusion then, savings, little evidence of an offsetting increase in interest charges or other costs. We find no evidence of a decline in access to credit. If there are other places that we should look in the data, I'd love to hear it. our goal is to analyze this as comprehensively as possible. All right. So I guess I'm moving a little bit faster than I anticipated. All right. So let me then tell you a little bit about the Payoff Nudge, and maybe we'll finish 5 minutes earlier, or we can chat a little bit about the research when I get done. And so the other sort of main component of the CARD Act, or one of the other main components, was this nudge, the disclosure that you would see on a credit card report on your monthly bill, which would tell you both the cost of making the minimum payment and the savings that would accrue if you made payments of the amount which would pay off your debt within 3 years. Right? So I think the idea is quite obvious that by teaching people the savings from making slightly larger payers, maybe you would nudge people into making larger payment amounts. So let me set the stage again by presenting some baseline data on credit card repayments. Let me actually skip this one and start with this graph. This shows the share of accounts making a full payment of their credit card balance by FeeCo score. So people with FeeCo scores in excess of 760, so the top 25% of the distribution, a lot of them are 60, 70, 80% of those individuals are paying off their full balance every month. People in the bottom 25% of the distribution, people below 620, this was shocking to me, a very low percentage. Yes?
Like, I don't know how the FeeCo score is built, but it might take that into account.
So that's a really good question.
In cases when you do the score, you look at the patterns of how you're paying. If you're paying in full, you're going to get a higher score.
So that's a great point. We did this incorrectly really the first month or two of this project. What we hadn't thought about, and the point you raised, is that payment behavior can affect your FeeCo score, and FeeCo scores can affect the type of cards you get, and so these things are all circular. So the FeeCo scores for every graph I'm showing you is the FeeCo score at account origination. So this is not contaminated by any subsequent payment behavior in the card. So I think it's a way to inoculate ourselves against that sort of reverse causality. It's a really great point. I wish you had told us that when we started the project. Yes?
Looking at this, I have the feeling that the groups with the higher FeeCo score, they are using credit card just as a way of payment, right?
Right. They're transactors.
It's a transaction way. While the people with the lowest FeeCo scores, for them it's actually extra money for that period that they wouldn't have access otherwise. That's right.
Our stylized view, and I think we still need to run some more analysis, is there's a lot of people who will use a credit card with a $2,000 limit, let's say for purchases around Christmas one year, and then make minimum payments for a number of months until they find a period in their life when they can repay it more significantly, or perhaps until something else happens in their life and they end up having to default. So I agree with that sort of stylized view. There's transactors and revolvers. Seems to be very few people in between. So here's the other part of this picture. This is just the share of people making the minimum payment or less by FeeCo score. And as you would have guessed, about 40% of people are only making the minimum payment or less if they have really low FeeCo scores. People with high FeeCo scores, very few, only 10% making minimum payments. Yes?
I don't know if it's significant. It's interesting, at the very right end of the spectrum, you had a slight dip, and here you have
right.
a slight increase.
Yeah, so I actually do know what's going on here. So it seems, or what I've been told is people with the highest FeeCo scores, so above 800, they're more likely to be small business owners. And even though we're only looking at personal credit card accounts, these people, they tend to be doctors, lawyers, other self-employed people. they're actually a worse credit risk than people with, so these people might spend a lot per month on their card, $25,000 if they're putting business expenses on the card. They're actually a worse credit risk than people with FeeCo scores, around, let's say, 6 or 780, in ways that aren't captured by the FeeCo score. So, you see someone paying off the full amount of a, let's say, $25,000 balance every month for 30 months. And what you don't realize is that every now and then one of these people goes bankrupt and they don't pay anything. And so that's a real risk for the small business. For these people who are using credit card accounts for small businesses, it's less of a risk for people with 780s or 760s. So you do actually see this sort of increase in charge-offs and sort of decrease in sort of high quality payoff statistics at the really top of the distribution. That reason. That's what I've been told, actually, if someone knows more than I do. Here. Yes?
The definition of full payment, is it the full payment until the exact due date of the bill? Or if I pay, let's say, 5 days later, but I pay the full bill, am I still considered full bill, full payment?
No, we're basing it on whether you pay the full amount on time. I don't know. We can look at how many people.
Something that maybe affect particularly the lower end of the data.
Yeah.
The fact that those guys that didn't pay are most likely to be they forgot to pay. It's not that they didn't have the money. Sometimes, I didn't pay my credit card, but I had amount of money which would, be much more than that.
Right. So that's something we should look at. It's a good point. I think it's just something we should look at. Yes?
Is income or age highly correlated with FeeCo score?
I think so. We don't know. So I think that's a general impression. We don't have a data set which has both income and FeeCo score in it. That doesn't mean such a data set doesn't exist. We could easily look at the correlation between age and FeeCo score. I assume there's a strong correlation there. People who've only had so for example, I have colleagues who just moved to Booth from a PhD outside the United States. Right? They're making a good salary. They have a guaranteed job for a number of years. They can't get a credit card because a standard restriction in access to credit is how many years you've had an account. So if you haven't had an account more than 24 or 36 months, it's unlikely for you to have a large credit limit. So that's correlated a lot with age too. If you're young, you're not going to get a large account. I would suspect this is strongly correlated with income. Hopefully at some point I will get a data set which allows me to sort of assess that. All right, so I guess starting to conclude. So here's, I think, the effect of the Card Act, basically summarized in this one chart. So there's, what we do is for every account, we can see their repayment amount, and we can basically calculate this number in months for that account. So we can say if they made that payment in perpetuity and didn't accrue any more charges on their card, how long would it take them to pay off their account? And so if we see a lot of people clustering around 36 months, 3 years, then we know a lot of people have looked at this and said, well, maybe I should increase the amount of payments so I can save this amount. All right. So what do we see in the data? Well, this is the 36-month amount. The dashed line, I guess they're hard to disentangle from the solid lines, but this is the dashed line. You see a spike of people at that point, and you see that they're shifted from here. So they're shifted from making payments that would lead to a larger number of months, so a lower payment amount. So it seems like this is the intended effect of the Card Act. It's shifting people to the 36-month payment amount from paying lower amounts. That's what the people who wrote the legislation wanted. I think what they may be less happy about is this increase is actually quite small. We're zooming in on a certain part of the distribution. The number of people who change, or the number of accounts that change, is about 0.5% of account holders. If you try and be really optimistic and you assume that they're all going from paying the minimum amount to paying that 36-month amount, because that increase in payment is actually quite small, maybe from paying $25 to $62, it doesn't save them a huge amount in interest charges. We calculate aggregate effects of about 70 million. So pales in comparison to the $20 billion in savings. Yes?
Another point from the previous part. You said that the credit card business made a lot of money with the low FeeCo scores,
Mm-hmm.
and now that they were the ones that received the
Biggest decrease in fee revenue.
So, because they are using it, the credit card as more as a loan than as a credit card, like as a usual transaction credit card, maybe the switch is related to that. Maybe what you have to analyze is the interest rates and the volume in loans for the FeeCo score, for the low FeeCo score.
So that's a good point. Let me tell you what we do. I don't know if it's sufficient. So all the numbers I was presenting was like fee revenue as a percent of average daily balances. So everything is normalized by the amount people are borrowing. Now you could argue that's not the right normalization, but I am basically accounting for the amount that different groups are borrowing in those calculations. I think there's other ways you could show it as a percent of transaction volume. For example, that would give you a different window on the data. This seemed to be most natural. Compare everything as though it was an interest rate. But we can talk after if you think there's other ways of presenting the data, thinking about the data.
No, not presenting the data. No, I'm saying that you could have like the analysis of these customers with like their consumption patterns for loans. Not credit cards, but like the usage of loans. Because if these guys are replacing, like, if the bank is trying to replace, like, the usage of the credit card for these guys to loans, that have a different rate, they can compensate the revenue that they're losing.
Oh, that's an interesting point.
That was what I'm saying.
Yeah.
Maybe I wasn't explaining.
No, that's interesting. So we had, I think, something that policymakers, I think, would have not liked is if credit card issuers cut off access to low FeeCo score borrowers because of this regulation, and that those people then got more payday loans, got more loans from loan sharks. Right? That would have been a really sort of depressing unintended consequence of this regulation. My reading of the evidence, and I think there's probably more things we can look at, is there's unlikely to be much of that going on. But another story, and I don't know what your name is, another story you raised is that maybe banks are pushing products to these consumers where they earn more profits. Now that seems completely natural to me, that if you're making less money from product A and you already have an existing relationship, well, you should push product B and product C. It would be interesting to get data from a bank about all of their various forms of lending and see whether they are moving consumers towards different accounts. I wouldn't be surprised if some of that was going on. All right, so that's the effect of the nudge. So let me conclude, since I guess my throat is getting sore too. I'm recovering from a cold. So our view, based upon this data, we still want to look at many more things. Anything you suggest would be great. So the reduction in fees had a significant impact, 3 percentage point decrease in fee revenue as a percent of ADB. A 10 percentage point decrease for the lowest FeeCo score borrowers. Seems like, at least in this circumstance, I don't want to suggest that this is something which has external validity, but at least in this circumstance, for the 2 years where we have data post the Card Act, it seems like regulation can transfer surplus. What would happen in another industry, whether these effects will persist, I think is something I can only speculate about. It's something the data doesn't speak to directly. We see a precise but small impact of this nudge. I think one hypothesis for why the effect is small is that if you pay online, you may not actually even see that information disclosure. I know, for example, at Chase, I never saw that disclosure because I never clicked on the PDF credit card statement. All right, so thank you so much for coming. Happy to talk with anybody who has further questions, other insights about the industry. Thank you.